Ever feel like you need to, decode a brand new law or policy, but your brain just wants the cheat sheet?
Happens all the time.
You're not alone.
Yeah.
That's exactly what we do here. We dive deep into the complex stuff and, well, pull out the nuggets you really need to know.
Mm-hmm.
Today, we're tackling a big one that's back in the spotlight. The 2017 Trump tax law, officially the Tax Cuts and Jobs Act, or TCJA.
Right, the TCJA. And to get a handle on this, we've gathered a really interesting range of sources. We'll start with a critical look from Americans for Tax Fairness. That's from early 2018.
Okay, so an early take.
Exactly. It gives us an initial perspective on how the law was structured and what its impact was, predicted to be. Then we'll jump to a factcheck.org article from March of this year, 2025.
More current, then.
Yeah. And they're dissecting the current arguments around whether to extend these tax cuts. We also have reporting from Politico from May 2025 and some other pieces that map out the political landscape and what's at stake as these provisions get closer to expiring.
Right. And to understand the potential effects on the economy, we've got an economic impact report from EY. This was prepared for the National Association of Manufacturers just this past January.
And that one looks specifically at jobs and the economy, right? If certain rules aren't extended.
Exactly. Rules that encourage manufacturing. We're also digging into statements from Senate Finance Committee Ranking Member Wyden and others from April, highlighting the latest estimates on just how much it would cost to keep these cuts in place.
The cost is a big part of it.
Huge. And finally, a February 2025 overview from Bloomberg Government. It lays out the key parts of the TCJA and the political context as we head towards these expiration dates. Oh, and we even have the title of a poll from the Cato Institute that seems to be looking at linking tax cuts with spending cuts.
So, quite a mix. Our mission today, then, is to get really clear on a few key things. First, who were the main people and groups that benefited when this law first went into effect?
Right.
Second, what are the crucial parts that are about to expire at the end of this year, 2025? And third, what are the different arguments being made right now about whether to extend or, change the TCJA? We're after those core insights that help you understand what's really going on.
Okay, let's get into it then. That early analysis from Americans for Tax Fairness, their report had a pretty attention-grabbing title, 12 Terrible Things.
Yeah, definitely grabs your attention.
And the very first thing they pointed to was the projection that by 2027, a massive 83% of the tax cuts would end up benefiting the wealthiest 1%. Can you walk us through how they arrived at that number?
Absolutely. Their reasoning, which was based on data from the Tax Policy Center at the time, centered on two main aspects of the law. One was the permanent cut to the corporate tax rate.
Okay.
They argue this would disproportionately benefit those at the top because, well, they tend to own the most stock and have the most investment income.
Makes sense.
The corporate tax rate was slashed from 35% down to 21%, and the corporate alternative minimum tax, the EMT, was done away with permanently.
Permanently. Got it.
And the second part was that many of the individual income tax cuts, the ones providing relief to working families, were designed to expire after 2025.
Ah, so they were temporary.
Exactly. So the idea was that as these individual cuts phased out over time, the relative share of the total tax benefit going to the very top would increase dramatically. That's how they get to that 83% figure for 2027.
That's a huge shift in who benefits. They also mentioned that back in 2018, the richest 1% were estimated to receive around 21% of the cuts.
That's right.
So it sounds like the expiration of those individual cuts is the key driver in concentrating the benefits at the top, at least according to their analysis.
Precisely.
And what about their claim that millions in the middle class could actually see their taxes go up down the road?
Yes. Their 2018 projection was that by 2027, something like 92 million middle-class families, and they define that as over half of households earning under $200,000 annually, could face a tax increase.
92 million.
Yeah. This was directly linked to the expiration of those temporary individual income tax cuts. They specifically highlighted that around 69 million households with incomes under $100,000 could end up paying more.
Wow.
The underlying idea is that the revenue lost from the permanent corporate tax cuts and the initial individual cuts would eventually need to be accounted for, and letting the individual cuts expire was a primary way that was structured in the law.
So permanent tax relief for corporations, but temporary for individuals. That's a really, really important difference, isn't it?
It's fundamental to understanding the long-term effects they were projecting.
They also raised a red flag about the impact on the national debt.
That's right. Americans for Tax Fairness estimated that the TCJA would add somewhere between $1.5 and $2.2 trillion to the national debt over the following decade.
Trillion with a T.
Yes. Their concern was that this increase in debt could put future funding at risk for critical social programs like Social Security, Medicare, and Medicaid. They argued that the law prioritized giving tax breaks to the wealthy and corporations without identifying sufficient ways to pay for them, essentially meaning the government would be borrowing to cover these cuts.
And they didn't shy away from pointing out who they believed were the biggest winners, did they? They specifically talked about wealthy business owners and real estate developers and this 20% pass-through business income deduction. For someone who might not be familiar, what exactly is a pass-through business? Can we break that down?
Sure. Okay, let's break that down. Pass-through businesses are structures like sole proprietorships, partnerships, LLCs, limited liability companies, and S corporations.
Okay.
Unlike traditional corporations, C Corp, that pay their own corporate income tax, the profits from a pass-through business, well, they pass through directly to the owner's personal income. And then they're taxed at the individual income tax rates. The TCJA introduced this 20% deduction on what's called qualified business income, or QBI, from these pass-through entities.
So a 20% cut, basically.
Essentially, yeah, on that specific income. Americans for Tax Fairness emphasized that a large majority, they estimated over 80% of this particular tax cut, was projected to flow to the top 5% of earners in 2019.
Top 5%.
Right. They also pointed out that then-President Trump had ownership stakes in over 500 of these pass-through entities. So this deduction essentially gave a significant reduction in the effective tax rate for many high-income individuals who own these types of businesses.
Right. So instead of their business income being taxed at their, regular high individual rate, they'd essentially get a 20% discount on that portion.
That's the gist of it.
And the analysis also suggested the law might encourage companies to move jobs overseas. How did that work?
Yes, that was another key criticism they raised. The TCJA shifted the U.S. towards what's known as a territorial tax system. Yeah. In simplified terms, this means that a larger portion of the profits that U.S. corporations earn from their operations in other countries are exempt from U.S. taxes.
Oh, okay.
And the remaining foreign profits might be taxed at a lower rate than domestic profits. The worry expressed by critics like Americans for Tax Fairness was that this change would make it even more attractive for multinational corporations to move their operations, and therefore jobs and investments, to foreign countries with lower tax rates.
And they used some pretty well-known companies, Apple and Microsoft, as examples when they were talking about offshore tax practices, didn't they?
Yes, they highlighted that many large American corporations had accumulated, trillions of dollars in profits held offshore.
Yeah.
Rather than requiring them to pay the full U.S. taxes owed on these profits when brought back, the TCJA offered a significantly reduced one-time tax rate on those previously untaxed earnings.
A kind of tax holiday.
Sort of, yeah. They estimated that this amounted to a substantial tax break, around a $400 billion discount in total for companies with offshore profits. And they specifically mentioned that companies like Apple and Microsoft could see savings in the tens of billions of dollars from this provision.
Another part of the law that sparked a lot of debate was the limit placed on the deduction for state and local taxes, or SALT. What was the concern there, according to this initial analysis?
The SALT deduction cap.
Right.
They argued that the new $10,000 cap on the federal deduction for state and local property taxes and income or sales taxes would disproportionately affect middle-class families, particularly those living in states with higher tax burdens, think California, New York, New Jersey.
High tax states.
Exactly. They noted that nearly 8 million families experienced a tax increase in 2018 directly because of this new limit. And they predicted that it could put a strain on state and local government budgets, potentially leading to cuts in essential public services like education and healthcare. For those living in higher tax states, that $10,000 cap could represent a significant increase in their federal tax bill compared to before.
And rounding out their list of terrible things were the changes to the estate tax and, perhaps not surprisingly, the potential for the Trump family itself to benefit from these changes.
Right. On the estate tax, they explained that the TCJA significantly weakened it by doubling the exemption threshold.
Doubling it.
Yeah, it went from roughly $5.5 million per person to $11 million per person.
Mm-hmm.
So for married couples, that's $11 million up to $22 million.
Wow, okay.
This meant that far fewer wealthy families would be subject to the estate tax when passing on their assets to their heirs.
Fewer paying the tax.
Much fewer. Finally, they pointed out several ways in which the law could directly benefit then President Trump and his family, including the lower top individual income tax rate, that pass-through deduction we just discussed, and the fact that certain real estate tax advantages were preserved. They did acknowledge, though, that it was difficult to calculate the exact savings for Trump due to his decision not to release his tax returns.
Okay, so that gives us a pretty critical initial perspective on the law. Very clear viewpoints there. Now, let's fast forward to the factcheck.org article from March of this year, 2025. The central question they were investigating was, who would benefit the most if these individual tax cuts, which are set to expire at the end of this year, were to be extended?
Exactly. And it's a crucial question because, as they highlight, the debate around extending these cuts has become very, very partisan.
You see that everywhere.
Right. You have Democrats often arguing that extending them would overwhelmingly favor billionaires, maybe citing that earlier analysis we talked about. Meanwhile, Republicans, including former President Trump, contend that it would be a broad tax cut benefiting everyone. Factcheck.org aimed to look beyond this political rhetoric by examining various independent analyses.
Okay, so what did those independent analyses indicate? Would the average person see a noticeable difference if these cuts were extended, or is it really all about the top end?
Well, the general consensus from nonpartisan groups like the Tax Policy Center, or TPC, was that, on average, taxpayers across all income levels would see some degree of tax relief if the individual tax cuts were extended.
On average, okay.
Yeah, that's key. They even provided some specific examples. For instance, TPC estimated that the average middle 20% of income earners, those with incomes roughly between, say, $65,000 and $116,000, could see an average tax cut of about $1,030 in 2027 if the cuts are extended.
So over $1,000, that's not insignificant for the middle, at least on average, as you say. But I'd imagine the benefits aren't spread evenly across all income levels.
No, definitely not. The distribution is certainly not uniform. While the average across all income groups might show a tax cut, the size of that cut, both in absolute dollar terms and as a percentage of their income, is much larger for higher income individuals.
Right.
Factcheck.org pointed this out clearly. Those earning under $50,000 might see an average tax cut of around $273. Whereas those with incomes over $1 million could see a substantial average tax cut of nearly $79,000.
$79,000. Okay, that's a huge difference.
It is. So while many people would experience some tax benefit, the wealthiest would clearly receive the largest share in dollar terms. This reflects, the progressive nature of the income tax system itself, where higher incomes face higher marginal rates, and many of the expiring provisions offered more significant relief at those higher income levels to begin with.
And what about Trump's assertion that these were tax cuts for everybody? Did the fact-checkers find that to be accurate?
Factcheck.org concluded that that statement wasn't entirely accurate.
Not quite.
No. While the analyses they reviewed suggested that roughly 3/4, maybe 75%, of households would likely see some form of tax cut if the TCJA's individual provisions were extended. Around 10% of households could actually see their taxes increase.
Increase. Interesting. Why?
It often depends on the interaction of different provisions, like the SALT cap we mentioned, or the elimination of personal exemptions, which were replaced by the larger standard deduction and child tax credit. For some families, especially larger ones in high-tax states, the net effect could be negative even with lower rates. So it wasn't a universal tax cut as claimed.
Okay. The factcheck.org piece also touched on something else, the possibility of spending cuts being linked to these tax extension efforts. That sounds like it could potentially offset any tax benefit for some people, right?
Exactly. That's a really important point they raised. If Republicans, for instance, decide to pursue cuts in government spending on programs like Medicaid or SNAP, the food stamp program, in order to offset the significant cost of extending the tax cuts,
which we know is substantial.
Right. Then lower-income Americans could ultimately end up in a worse financial position overall, even if they do receive a small tax cut on paper. This really highlights how interconnected tax policy and social spending decisions can be, doesn't it?
It really does. You can't look at one in isolation. Now, let's turn our attention to the political landscape. Bloomberg government and Politico both paint a picture of this upcoming decision on whether to extend these tax cuts as, well, a major political showdown in Congress. It's clearly not just about the economic numbers.
Absolutely not. Politico, in their May 2025 coverage, framed the potential extension of these Trump tax cuts as a central and, frankly, highly contentious issue. especially given the current balance of power in Congress and the White House. The stated goal of many Republicans is to extend these cuts, and they might again try to use the budget reconciliation process to achieve this.
Reconciliation again. Can you remind us quickly what that allows them to do?
Sure, budget reconciliation is a specific set of rules in Congress. It allows certain types of legislation, mainly those dealing with the budget like tax changes, to bypass the usual requirement of 60 votes to overcome a filibuster in the Senate.
Meaning they only need a simple majority.
Exactly. They can pass it with just 51 votes, or 50 plus the vice president's tie-breaking vote. That's how the original TCJA was passed in 2017.
Okay. But Bloomberg government pointed out that there might be some hurdles to this, even within the Republican Party itself this time around.
Yes, it seems there are a few significant challenges. One major one is just the sheer estimated cost of a full extension. Politico reported that the plan being discussed by the Ways and Means Chair, Jason Smith, carries an estimated price tag of around $5 trillion.
$5 trillion.
Yeah, which is already above the $4.5 trillion budget framework that Republicans had previously agreed to. So that raises serious questions about how they plan to account for that, roughly $500 billion difference.
Where does that money come from? Or does the debt just go up?
That's the big question. Additionally, there appear to be ongoing internal disagreements within the GOP, particularly concerning that cap on the state and local tax deduction, the SALT cap.
Still fighting over SALT.
It seems so. Lawmakers representing states with higher state and local taxes are still pushing hard for some form of relief from that $10,000 cap. That adds another layer of complexity to the negotiations. It's hard to get everyone on the same page.
And what about some of the more ambitious tax proposals that Trump has mentioned on the campaign trail, like potentially eliminating taxes on tips and overtime pay? Do those factor into this debate about extending the current cuts?
That's another complicating factor. Politico noted that those additional proposals, if pursued, would introduce even more complexity and, crucially, significantly increase the overall cost of any tax extension package.
Making that $5 trillion number even bigger.
Potentially, yes. It remains to be seen whether Republican leaders will attempt to include these further tax cuts as part of their strategy. Doing so would likely inflate the total cost even further and could face even greater resistance in Congress, maybe even among some Republicans worried about the deficit.
So it sounds like we could be looking at a few different outcomes then, as Bloomberg government outlined. Maybe a long-term extension of most or all of the current tax cuts?
That seems to be the Republican goal.
Or maybe a more temporary short-term patch to just delay the expiration and kick the can down the road?
That's certainly possible if they can't agree on a long-term fix. A punt.
Or even a scenario where Congress just fails to act before the end of the year, leading to a full expiration of many of these provisions. That last one seems like it would create a lot of uncertainty, maybe chaos.
It does seem less likely, given the stakes. But as Bloomberg government highlighted, if Congress is unable to reach a consensus, the various TCJA provisions would indeed expire as scheduled. That would effectively mean reverting to the tax rules that were in place before 2017.
Which would be a big shock to the system.
Absolutely. It would undoubtedly create significant uncertainty and require major adjustments for both businesses and individual taxpayers. The underlying partisan divide is quite evident here. Republicans generally advocating for extending the cuts, maybe even further reductions. Democrats, on the other hand, are more inclined towards reforming the existing tax breaks to provide more benefit to lower and middle income earners and to increase taxes on higher earners and corporations. Very different philosophies at play.
Okay, now let's shift our focus a bit to the potential economic consequences of allowing these tax policies to expire. We have that EY report prepared for the National Association of Manufacturers. Their analysis sounds like it's forecasting some pretty significant negative impacts if things just sunset.
It does. The EY report specifically analyzed the potential economic effects of allowing 9 particular tax provisions within the TCJA to either expire or gradually phase out.
9 specific ones?
Yes, ones they see as designed to encourage manufacturing and investment. These include things like the ability to immediately deduct expenses for research and development R&D expensing.
Okay, that sounds important for innovation.
Crucial. Also, the ability to fully expense certain capital investments, what's called 100% bonus depreciation. Rules governing the deductibility of interest expenses, that 20% pass-through deduction we discussed earlier.
Right.
Individual income tax rates and brackets, the higher estate tax exemption, and certain international tax provisions known as FDII and GILTI.
FDII and GILTI. Can you briefly remind us what those do?
Sure. FDII, foreign-derived intangible income, was basically intended to incentivize companies to keep intellectual property, like patents and related activities within the U.S. GILTI, Global Intangible Low-Tax Income, was designed to tax the foreign earnings of U.S. corporations at a minimum rate to discourage shifting profits purely to low-tax havens abroad.
Got it. So these 9 provisions, they have different expiration dates.
That's right. Some have already started phasing out or expired, like changes to R&D expensing that began in 2022. Others, like the individual rates and the pass-through deduction, are set to expire fully at the end of 2025.
Okay, so what was EY's main conclusion? What kind of economic disruption were they projecting if these provisions were allowed to expire?
Well, their analysis of economic activity disrupted, which takes a more focused, partial view of the economy, looking at specific sectors, estimated a potential loss of around 5.9 million U.S. jobs.
5.9 million, that's huge.
It is. Also, a decrease of $540 billion in U.S. employee compensation, and a reduction of $1.1 trillion in overall U.S. GDP. They particularly emphasized the manufacturing sector and related industries, predicting a disproportionately large impact there, with potentially over 1 million jobs at risk just in those areas.
Wow, those are really substantial numbers. What's their reasoning behind such a significant predicted impact, especially on manufacturing? Why is that sector hit so hard in their model?
Their argument is that manufacturing is generally a very capital-intensive industry.
Meaning lots of machinery, factories.
Exactly. It requires significant investment in equipment, technology, and facilities.
Yeah.
And it relies heavily on ongoing research and development to stay competitive.
Okay.
So the expiration of provisions like the immediate expensing of R&D costs and the ability to fully expense capital investments, well, that would effectively increase the cost of making those crucial investments.
Makes them more expensive.
Right. And if it's more expensive, businesses are less likely to undertake them, or they'll do less of it. Stricter rules on the deductibility of interest expenses would also make it more expensive for manufacturers to borrow money for those investments.
And the pass-through deduction.
The sunsetting of the pass-through deduction would increase the tax burden for many manufacturers that happen to be structured as pass-through entities. And even changes to individual income tax rates could potentially reduce the labor supply or increase labor costs for these businesses.
So it hits them from multiple angles.
That's the argument. The core insight here from their perspective is that these tax policies act as powerful incentives. If businesses face higher costs for investment in R&D due to expiring tax breaks, they are likely to scale back those activities, and that directly impacts job creation, wages, and overall economic output.
The report also mentioned a more comprehensive macroeconomic impacts analysis using their EY macroeconomic model. What did that broader analysis reveal? Did it confirm the sectoral view?
That analysis, which takes a more holistic, general equilibrium view of the entire economy, still projected significant negative consequences, though the numbers were a bit different, as you'd expect from a different model.
Okay.
They estimated an average reduction of about 2.9 million U.S. jobs in the first 10 years following the expirations, and an average annual reduction in U.S. GDP of around $470 billion during that same period.
Still very significant numbers.
Yes. And they projected those impacts would actually worsen slightly over the longer term, with GDP reduction potentially reaching $780 billion annually in later years. These longer-term effects were attributed mainly to reduced levels of investment leading to a smaller overall capital stock in the economy, fewer machines, less technology, and consequently, lower levels of productivity growth.
They did point out some important caveats to their economic modeling, though, right? It's not like a perfect prediction of the future engraved in stone.
Oh, absolutely. That's a really important point to keep in mind with any economic model. They acknowledge that their models are necessarily simplified representations of the very complex U.S. economy. They can't account for every single factor or predict unforeseen events.
Sure.
Their estimates are also based on publicly available data, which might have limitations. And they're sensitive to the specific assumptions they make, particularly regarding how the government might choose to use any additional revenue generated from tax increases if these provisions expire.
What assumption did they make there?
Well, in their macroeconomic model, for example, they made the specific assumption that any extra government revenue would simply be used to fund government transfer payments, like Social Security or unemployment benefits. This allows them to isolate the effects of the changes in tax incentives themselves, rather than modeling, say, deficit reduction or government investment. They also noted their model assumes full employment in the long run, which is a standard but important theoretical assumption.
Okay, so important context for interpreting those big numbers. Finally, we have these increasing cost estimates for extending the tax cuts. As Senator Wyden and others have been highlighting, the price tag seems to keep going up.
Yes, that's the latest wrinkle. They issued a statement back in April of this year, citing a brand new estimate from the Nonpartisan Joint Committee on Taxation, or JCT. That's the official scorekeeper for Congress on tax matters.
Okay, what did the JCT find?
This new estimate projects that extending the 2017 Trump tax law in its entirety would now cost approximately $5.5 trillion over the next decade.
$5.5 trillion.
Yes, and that figure includes the cost of interest on the additional debt the government would likely take on. If you exclude the interest costs, the direct cost is estimated at $4.6 trillion.
And that's higher than before.
It is. It's worth noting that these figures are definitely higher than previous JCT estimates, which were closer to $4.6 trillion with interest and $4 trillion without. So the estimated cost has jumped significantly.
Why would it go up? Economic projections change.
It could be changes in economic forecasts, updated baseline projections for the economy and tax revenues, or refinements in how they model the effects of the law. But the bottom line is the projected cost is substantial.
And Wyden's statement also mentioned potential additional tax breaks.
Right. They pointed out that Senate Republicans were apparently considering a budget resolution that would allocate an additional $1.5 trillion for further tax breaks on top of extending the current law. If you add that to the $5.5 trillion extension cost, the potential total cost of the Republican tax agenda could exceed $7 trillion over the next 10 years.
$7 trillion, that's an astronomical figure.
It's a number that certainly gets a lot of attention in budget debates.
And the central criticism, as we've heard before from sources like Americans for Tax Fairness and now echoed by Senator Wyden, is that the primary beneficiaries of these substantial costs would be, again, the wealthiest individuals and large corporations.
That is the core of the concern being raised by Democrats and other critics.
Yeah.
They specifically question how these significant tax cuts would be financed. Would it lead to cuts in vital programs? They mentioned things like health insurance access or initiatives to combat child hunger. Or would it, perhaps more likely, simply add substantially to the already large national debt? That's the debate.
Okay, so let's try to pull all of this together. It's a lot to digest. Based on the sources we've looked at, it seems that, well, the initial design of the 2017 tax law, according to some analyses, like the one from Americans for Tax Fairness, was structured in a way that would increasingly favor the wealthy and corporations over time.
Right, largely due to that dynamic of permanent corporate cuts versus temporary individual cuts.
Exactly. And the current debate over whether to extend those individual cuts is, as you said, highly partisan. We've got factcheck.org showing different groups offering very different perspectives on who would actually benefit the most if they are extended.
With TPC suggesting average cuts across the board, but much larger ones at the top.
Right. We've also seen from the EY report that there are potentially significant economic consequences predicted, particularly for the manufacturing sector, if certain key tax provisions are allowed to expire. Big job numbers potentially at stake there, according to that analysis.
Yeah, focusing on the incentive effects of those specific policies.
And finally, the cost. The cost of extending these tax cuts is substantial, running into the trillions, and has become a major, perhaps the major, point of contention in Washington, D.C., with those JCT estimates rising.
Exactly. Understanding these different angles, the initial impact and structure, the current partisan debate over extension, the potential economic consequences of expiration, and the significant financial cost. It's really crucial for anyone trying to make sense of the economic and political landscape right now.
It really is.
Those approaching expiration dates at the end of 2025 create a real pressure point. The question of who benefits from these tax policies is fiercely debated, and the potential economic stakes, as different groups interpret them, are incredibly high.
So here's a thought for you, the listener, to chew on as we wrap up. Given these substantial projected costs, running into the multiple trillions of dollars, and the widely varying analyses of who truly stands to gain the most, what fundamental principles of taxation and economic fairness should ultimately guide our decisions about the future of these tax policies?
That's the core question, isn't it?
It is. Think about the long-term implications, not just for next year, but for the next decade and beyond. What are the implications for different segments of our society, for low-income families, the middle class, high earners, corporations? And what about the overall health, stability, and maybe even competitiveness of our economy? Lots to consider there.